just thinking about private placements versus buying and selling on the market. And I just think it's such a relevant kind of two very different ways to think about how to play the junior market. But when you're a retail investor, even if you can become an accredited investor and participate in placements in any way, you often don't even realize that's available to you early on. And then if you do realize it's available, you might still not have access to it. So I just want to get an idea from both of you guys, like right now, both of you have the ability to participate in private placements, but I believe when you started in juniors, you didn't participate at all. Because you can, is it something where you feel that for the future and in recent times, you're going to be more weighted towards private placements, or if you're kind of 50-50 with placements and buying and selling on the market, or if, for whatever reason, you actually see more merits in buying on the market? Just kind of, you can go in any direction on those points.
Sure. Yeah, it's a great question. Okay, so the way I see this, and I think Nick and I mentioned this yesterday, is I'm very much geared towards private placements now. But it's a tightrope in a sense, especially for me right now. And this may or may not be published. I don't know if I'm going to edit this out or leave it as is. But with private placements, if you have the sort of defensive strategy to, buy into private placement, preferably at a slightly cheaper price than what's being traded in the market, then short the stock to protect your downside and keep the warrants and use that money to, sell it off and use it for the next private placement. You're essentially almost putting yourself at zero risk, and you're using the same amount of money to participate in many different stories that might, maybe someday work out. I can't think of any better investment strategy than doing that. The other side of this is that there is a problem in the sense that when we start talking about companies, especially, the three of us, because we have I'd say small but still public profile. When I say that I like this company and I'm shorting it, I think there's a problem. Especially if you know management or if you're sponsored by management, as I might become, this year. It's like, okay, where do you draw the line of ethics of saying that this is a great stock and participating in the private placement, which should help the company further its goals, but at the same time, that it's an extremely risky investment and wanting to protect your downside, but at the same time, by shorting, you're increasing the supply of shares and therefore helping the stock to go down, and retail might be affected by that, and retail is usually the people that you're talking to about that company. So it's very, very complicated. It's not like a cut and dry, easy answer. I haven't shorted. I've never shorted anything. I've placed bets basically on things going down, but I don't even do that anymore. But I think overall, private placements are great. I would love to see the private placement law, so to speak, completely change and just allow everybody to come in. And I have my theories as to how the industry would improve through that. But it's almost like too good of a strategy, but then you have to be careful on how you go about it because you might burn yourself while you're trying to, protect your capital at the same time. So that's a really convoluted answer.
That's a great question. That's a great answer. I don't think actually I've ever heard anyone phrase it that way, where that's a strategy you can use to protect the downside with the shorting. But it makes a lot of sense when you think about it, because with private placements, usually in some cases there's like a 4-month holding period, right, where you can't sell the stock. So anything can happen. And usually when you get a lot of these private placements, I guess with the best terms, with the attached warrants, whether they're half warrants or full warrants, and they have that long expiration, whether it's 2 years or, if things get really bad, you could see 3 to 5 years. So those are like the most juicy type of deals, right? It's usually they're present in a bad market environment. It's flat to neutral or even heading down. But again, like you said, Fabby, that's the risk you take, is the stock price can keep going down because it is a weak environment, but you're in it for the warrants primarily. So that seems like a good strategy. If you're kind of looking at it more, in the eyes of retail, like one thing I kind of threw out there for a while is you don't have to necessarily feel like you're missing out if you can't get in private placements, because with a lot of cases, what I've seen is just from tracking stories is within a few months, if it's a weak market, and I mentioned this yesterday on MBG Trends, is even for like a big company, I mean, we don't even have to talk about juniors. Like there was a placement for Resolute Mining, and it was raised. They raised $150 million at $1.96 per share. So I don't think in that case there were any warrants attached. But as retail, like one strategy that I've used is just to follow stories, and if you can get in at substantially cheaper cost basis and price per share than recent financings, that's a way you can get a leg up with the competition. Because in my eyes, the way I looked at it is, if I get in today and I can buy, let's say, for example, like with Resolute, it actually fell as low as, like, let's say 96 cents a share. You're getting over a 50% discount, to the recent financing. So yes, anything can go wrong with mining, but if $150 million was raised at basically 2x of your entry point, your downside is, in a way, it's going to be less than what some other people are feeling. So the way I look at it is, in a way, that's like the opposite of dilution. I usually just term it like anti-dilution, because on the flip side of that, it's like if you're somebody who's getting in, and let's say you're paying $2.50 a share, and let's say there are warrants attached, and all those warrants are going to be in the money, then in a way, you're the one who's going to be most at risk with experiencing dilution, because not only are you buying higher than all the recent financings, but if there's warrants attached and they're in the money, then people are going to want to look to execute those warrants, right? So there's going to increase the float, and then you're still buying your shares way above that price. So that's always that fear. So I just try to take advantage of just bad market environments where it's not a knock on any individual company, but it's just, if they do a placement, the stock price crashes 50%. Yes, because I don't get into the placement, I don't get access to the warrants. But if you can just buy shares as retail on the market, and you're getting in, let's say 30 to 50% or more than that, then I think that's kind of one way you can get an edge. Just playing the retail game. And it's in a way, it's a lot simpler, because with placements, you have to it's not a lot of work, but you still have to like fill out the forms, and it can be difficult if you get like the physical shares, and then you have to later convert it back to digital and stuff like that. And some retail investors, even if they are accredited and they can't participate, they just might not have the bandwidth or the interest. Let's just say you're just somebody who's busy with work all the time. You just want to be in the comfort of, like you're in your cubicle or something. You just want to be able to trade shares, and that's it. Like just really quick and simple process. Because I know a lot of friends like that who are like, let's say they're interested in the clean tech space, but they don't really have the time or bandwidth to follow up with private placements, and then having to keep track of, I can't sell this for 4 months. Like it's a holding period and all this stuff. So for them, if they can just get in as retail and they can buy in at good prices, then they could just go that route. And I always try to, I guess, emphasize that point whenever possible. If you can buy in at a huge discount to recent financings, then in a way you enhance the risk versus reward in your favor a little bit.
Yeah. Well, in general, I just tell people, do it as much as you can, even if it takes years to actually become accredited, because and I've actually taken the time to read the whole, I think it's NI 40 something something oh 06, which is the piece of paper that lays out the whole law about exemptions and who is accredited, who is not, who can take part, who cannot, etc. And there are people who can make maybe a career choice and become accredited. There are people that can become consultants to the company in any capacity whatsoever and become good for private placements. For example, if if a company consults with me about, I don't know, their social media presence, I'm a consultant to that company, I can take part in the private placement. Or if I'm friends with somebody who works in that company, management especially, then I can also, make that list. And so, yes, there is the long road of you have to have a, net worth of $1 million or the 200K per year for a couple of years. But there are also these other ways that could give you, an in some of those private placements. Not all of them, but some of them. There's also rights offerings and things like that some companies choose to go with, but most of them just go through, the lazy route of let's just raise with the usual accredited investor, the typical sort of person. And so this is what I tell people, like, try your best to actually make it, even if it takes a while. But the other thing is that even if you don't have access to that, if you don't want to, come out to Vancouver and make friends with people or become certified, as a financial person, etc., or any of those things, there's always the fact that, if you don't hedge, then you might be stuck with, the 4-month or the 6-month hold period and actually lose a lot of money. So it's not like this is a guarantee that you're going to make money in any stock. But if you play it right over time, I think this will make your portfolio look considerably better than if you hadn't. But there is a cost to that, and obviously the cost is the 4-month hold period. Like, I'm looking at a stock right now on co.ca, and it's down 50% from where I financed it, and I didn't short it. And so, that's half of my money gone, and it's probably going to get worse because it's not free trading yet. So there is still risk. You can protect your downside, but it's not like, a golden ticket.
I love those answers. I'll quickly add, especially for our Aussie and Kiwi listeners, it's amazing, but I don't think there's any hold period on the ASX. So very different way of going about things. So yeah, that's just something to keep in mind, the specific rules for exchanges. Before I add my 2 cents, I am just curious, since you guys have been able to participate in private placements, would you say that it's far less likely for you to buy and sell in the market, or somewhat less likely, or has that not changed too much? Just kind of the quick answer from each of you on that.
I'm way more likely to buy into a private placement than on a market, especially because companies want you to sign up for a decent, 5-figure amount.
I'm kind of, I guess, maybe more neutral on the stance, because I know with the placements, private placements, they can be really powerful, but it's also in the context of the greater macro cycle. So, like in 2016 when gold stocks were flying, then, you really enhanced your leverage with whatever placements that you could get into, and you had the warrants attached because you were making money both ways on the stock and the warrants. And, it was ridiculous, right? In 2016, a lot of the stocks were going like 3x to 5x or more. So, that's the quickest way to make money. But in a flat to down market, you really lose a lot of that potency of the warrants, because it's just, usually the stocks don't really do much. And then like I have warrants, like, for example, I got into Perseus, when they had the Amara acquisition. So those were like 2-year warrants, and they looked at the time, it looked like a good price. I forget exactly, don't quote me on this, it's like 44 cents or so. And, there were periods when the shares traded well above that, but, in the last year, it hasn't really gone much above that. So, even if I was to cash in on them and, your execution price is like 44 cents or so, there wasn't going to be much to actually gain from that. And, these things you don't know, right? Nobody has a crystal ball, but, for the most part, I guess I'm more inclined to just buy on the market and just look for favorable entry points. Like usually those moments of despair when everybody's throwing in the towel and they're just kind of frustrated and they want to give up because everybody was chasing these stocks a lot higher. And now, we're at 52-week lows it's just like these really nasty looking charts, especially like on the FA side where it's just the share price just looks obliterated. So, there's many approaches, but I almost feel like if you can get in like at that type of bottom and you're buying good quality companies that are fundamentally sound, but it's just more a consequence of a major price decline because of just negative sentiment, then that's just an easier way for retail to make money is to try to do that. But I think with both approaches, there's no guarantees, and you can make money both ways. On the upside, the private placements with the warrants are much more leveraged and you get the extra juice there. But trying to like time these markets and when they turn is pretty tough. I mean, even with my 2-year warrants that I had in that one instance with Perseus, I mean, they up to now, they really haven't worked out and they haven't really provided me anything extra. So, I'm kind of neutral on both, I guess.
No, it's very interesting to have two very different perspectives on that. And I thought, my own perspective, especially because I still can't participate in these placements.
For now.
For now. Yes. And I think that's what's interesting is that for me, there's an individual perspective and then there's kind of the health of the market. And from talking with Fabi earlier this week, I strongly believe the junior market is less healthy, not because placements exist, but because there's such a push to clip warrants, which absolutely makes sense from an individual perspective. I'm actually in Fabi's camp about, as an individual, you will basically be riskless if you're just constantly clipping warrants. And I think even Marin Fatusa is on record saying, the perfect portfolio is just warrants and cash. I think Newton reposted that. It's a good quote.
Yeah.
But when you start seeing that, I think not only is it kind of cynical about the market, it's like, oh, well, then you can't do well unless you're in these placements, or like that is the ultimate goal. I think it's very unhealthy because it goes towards, illiquidity. It means those types of people are not going to be buying and selling on the market. And it's not anyone's fault, but it's a problem with the general junior market, and it's something that maybe is even more extreme these days, particularly because of people like the success of people like Rick Rule, and that's my broker, Sprott Global. And I bring that up specifically not to knock on Sprott because I love it as a retail person, but I found Jay's answer earlier very curious about knowing people who work full time and actually prefer to buy and sell in the market. My experience at the Sprott Symposium felt like the exact opposite, and it might also have to do with the general aid group. When you look at people who've been probably been, this is just speculation on my part, clients of Sprott for 20 or 30 years, they've surely had lots of success with placements. There are companies that have done incredibly well on record, but a lot of those people they have a lot of money, but they work full time. And I could absolutely tell, I could feel it in the air. These people don't do their research. Either it's a combination of not having enough time and maybe not even, being able to, like not necessarily being qualified. And I don't feel like I am like some super special person, but I just could tell, nobody puts in this research here. The people who actually put the research are the people I talk to on CEO.ca. Not everyone, but, a lot of people, a lot more here than who go to those conferences. And so it bothers me when I see lots of commentary saying, oh, like you can only do well with placements or you need to be in placements. And I've heard that from a lot of people, like pushing in that direction. And what Jay said earlier, that's such a key point, is if the retail, a very important signal and a way to have an opportunity is to buy at a significant discount to the previous placement. But not only that, I was disappointed, even as a Sprott client, I was disappointed that so many of the companies at the Sprott Symposium are these full 5-year warrants. which is very different even from the Perseus deal that Jay just described, which is 2-year. And there's definitely a place for that. And again, from talking to Fabi, I think in the uranium space, it makes even more sense. Like, I would play the uranium space for placements in general, but I don't even want to do that right now compared to other sectors, because I think it's going to take I think that it's better suited there. But I shy away from companies that I think are quality companies, but that go in for this full 5-year warrant stuff with Sprott or with anyone else. I think it's unhealthy. I actually would go out of my way to find the companies that maybe they'll raise a half warrant or they'll raise it on a shorter term, but like they clearly are trying to balance the needs of retail and institutions. And sometimes companies are desperate, but it's a sign of desperation if they're doing the full 5-year warrants, or it's a sign of just not caring about retail. So I feel very strongly about that, because you have to put a lot of extra work to find the other types of companies out there, but that's what I spend all my time doing. And I think there's a good chance that some of the biggest winners in this sector will be companies where you actually need to buy and sell in the market versus being parts of placements. But there is no one right way to do it. I just want to make a strong comment that, like, I'm in the same boat as all the typical retail people out there, and I really feel you can do well in this industry, even if people keep saying, oh, you need to get in placements, or placements are the only way, blah, blah, blah.
I just really wish the rules for placement would be just completely done away with. And this is what I was saying previously. And let me just tell you the story quick, because we hadn't recorded this, so I think this is good for people to understand and know that this actually happened. So I signed up for an unnamed private placement about 2 months ago. And what happened was, I'd say somewhat close to market price for the shares, but it was a full warrant for 2 years. And so I signed up, I sent in my form and my money, etc. Everything was 100%. But they hadn't closed yet. And I knew that they were having a little bit of trouble raising, because, it had been quite a bit of time and they hadn't announced the closing of a raise. And then what happens is their IR guy comes back to me and says, actually, we've changed the terms to the raise. It's going to be a 5-year full warrant. Are you in agreement with this? And I'm like, yes, please. Wish I would have bought more, kind of thing. And then that's it. A few weeks later, they announced the closing of this placement. Then I go on Twitter, and just by complete accident, it just so happens that an institutional investor is claiming to be a big chunk of that particular raise. And so my understanding is, and I don't want to mention names because I don't like to be, hassled or sued, but my understanding is that retail is going to take, like, small investors like you and me are going to take whatever comes, if it's 2 years, if it's 3 years, if it's a half warrant or full warrant. If we think the risk is worth it, we're going to invest in that company and put, for us, what's a big percentage of our portfolio at risk. For an institutional investor, because they have a larger amount of money and because mining is so darn risky and such a bad business overall across the board, they are going to demand more. And so by actually doing away with the whole accredited nonsense, I think that more, bigger number of smaller investors would be willing to put money into these companies, and maybe there wouldn't be a need for a 5-year warrant as much as there is now with an institutional investor that comes in and pretty much requires whatever they feel like requiring at that time, which, in their defense, they have to protect their capital, and it's most usually not just their money, but also other people's money. So every time that they really miss, they need to have a huge win to offset that. And they report on maybe, quarterly or yearly basis. So they have to just keep a closer look on, what they're doing and what their results are on a monthly basis or so. But at the same time, I think that there shouldn't be this discussion of who's accredited, who's not. Like the fact that you make a larger salary than the person next door, or you have a, net worth that you got from, I don't know, maybe your parents selling their house or leaving you, like a, a large portion of their money, that shouldn't really dictate whether you understand the risk or not. And so to me, just do away with this whole nonsense because I think it's just hurting people.